Welcome to ValueVest Daily. Today we are diving deep into the market outlook for 2026. And folks, it is a fascinating picture. We're seeing a global economy that's way more resilient than anyone expected, but it's crashing right into some major global uncertainty. So the big question on every investor's mind is, how in the world do you navigate this? Let's get right into the data.
Okay, so here's our game plan. First, we'll paint the big picture of the 2026 market landscape. Then, we're going to zero in on the three key forces that are really shaping everything: geopolitics, that very tricky macro puzzle, and of course, the big one, AI. From there, we'll see where the money is actually moving, the sector shifts, and we'll wrap it all up by building a practical investor playbook to help you make sense of what's coming.
So what's the big story for 2026? Well, you can really think of it as a tale of two opposing forces. It's this powerful tug-of-war between an economy that just refuses to quit and this backdrop of massive, almost unprecedented global risk. And these two things are pulling the market in completely different directions, which, as you can imagine, makes for a very, very tricky environment.
And you can see this tension perfectly when you look at what the big banks are saying. You've got JP Morgan over here in the bullish camp, forecasting the potential for double-digit gains. But then on the other side, you have Goldman Sachs hitting the brakes. They're pointing to what they call hot valuations and all these underlying tensions that could really put a cap on returns. So the takeaway is pretty clear. There's optimism for sure, but it feels like it's walking a very thin tightrope.
Wow. This slide right here really captures the mood of the market. We're looking at the VIX, which you probably know as the fear index, and it just recently spiked over 24%. Now, that is not just a little blip. That's a huge signal from the market that investors are bracing for a lot more turbulence and risk ahead. So the question is, what's actually driving all this fear?
Well, that brings us to our first major driver, and honestly, it's the elephant in the room: geopolitics. You know, for a long time, these kinds of global events were sort of background noise for the market, something happening over there. That is absolutely not the case in 2026. These events are now front and center, a dominant force that is actively steering the markets and creating some serious headwinds.
And don't just take my word for it. This quote from Goldman Sachs just nails it. They say we're in a geopolitical power race, and the direct result is the creation of new commodity supercycles. And a supercycle is basically a long, sustained period of high prices because there's just not enough supply to meet demand. What this means is that global competition for essential resources is literally redrawing the map of how money and materials move around the planet.
So let's get specific. What are we talking about? Well, first, there's the escalating conflict between the US and Iran, which is hitting energy markets hard and fast. Second, the long, drawn-out war in Ukraine continues to destabilize European energy and create shortages in things like grains and industrial metals. And third, you have the constant simmer of tensions between China and Taiwan, which casts this huge shadow over the global supply chain for semiconductors. You know, the tiny chips that run, well, everything. Each one of these is a major flashpoint for the market. And here's what that risk looks like in the real world. That US-Iran conflict, it's pushed the price of crude oil up 17% to over $107 a barrel. This isn't just a chart. It's the direct result of military actions and shipping disruptions in the Strait of Hormuz, which is a critical bottleneck for global oil. This is pumping inflation right into the system, and it's causing a lot of investors to see energy as a defensive rotation, basically a safer place to park cash when things get choppy.
Okay, so we've talked about the shocks coming from the outside. Now let's pivot and look under the hood of the economy itself, because right now we are dealing with a really complex macroeconomic puzzle. You have these surprisingly strong growth signals that are clashing with inflation that just won't go away, and that puts central banks and investors in a really tough spot.
You know, one of the biggest surprises right now is just how resilient the economy has been. The IMF is calling for a solid 3.3% global growth, but the real story is the US. As this chart shows, it's just powering ahead, with Vanguard projecting 2.6% growth. And this strength is coming from a mix of fiscal policy, better trade relations, and a huge wave of investment in new tech, especially AI.
But, and this is a big but, here's the other side of that coin. Inflation is proving to be incredibly sticky. The Producer Price Index, the PPI, which basically measures inflation for businesses, came in hot at 2.9%. The core reading was even higher. This is absolutely not what the Federal Reserve wants to see. It tells them that price pressures are still lurking in the system, and it probably means any plans to cut interest rates are getting pushed back. So when you have this cocktail of geopolitical risk and stubborn inflation, where does money go? You guessed it. It runs to traditional safe havens. Gold is trading near record highs, over $5,200 an ounce.
But here's the really interesting part. This rally isn't just being driven by individual investors. A huge part of this is coming from central banks around the world who are buying up gold like crazy to diversify their reserves away from the US dollar. That is a massive structural shift.
All right, let's shift gears to our third and maybe the most fascinating driver, artificial intelligence. AI is truly the great unknown for 2026. It's the market's ultimate X factor. It has the potential to either launch economic growth into the stratosphere, or it could turn out to be one of the biggest investment bubbles we've seen in a long, long time.
And this really is the multi-trillion-dollar question, isn't it? Are we looking at the beginning of a true technological revolution that's going to redefine our entire economy, a genuine growth catalyst? Or is all this excitement, all this money pouring in, just inflating a massive bubble that's doomed to pop? Both sides have really compelling arguments, so let's dig into the data.
So when you look at what the big institutions are forecasting, they all seem to agree that AI is going to be a net positive for growth. As you can see here, the IMF thinks it could add up to 0.5 percentage point to US GDP. Vanguard is even more bullish. But what's really key here is that while they're debating the exact number, nobody is debating that AI is already a measurable economic force. This isn't science fiction anymore.
But we have to look at both sides. On the left, in the hype column, the skeptics point out that some economists think AI added basically zero to growth last year, despite all the headlines. They also rightly bring up the real risks of job displacement. But then you look at the reality column on the right. Companies are investing over $500 billion in AI infrastructure this year. That's real money. And long-term, we're talking about a potential $15.7 trillion global impact. The money is real, the potential is real, even if we're still figuring out the short-term impact.
Okay, so we've got the geopolitics, the macro puzzle, and the AI wildcard. So what does all this mean for your portfolio? Let's translate these big picture forces into actual market action. Where is the money really moving right now? Which sectors are winning, and which are getting left behind?
And wow, this table tells the whole story. We are seeing a massive rotation in market leadership. It's a total flip from last year. The top dogs this year are the old school sectors. Basic materials are up a whopping 20%, driven by those commodity shortages we talked about. Energy's right behind, up 19%, fueled by those geopolitical risks. Meanwhile, last year's superstars, tech and financials, are actually down, struggling with high valuations and rate uncertainty.
This chart just makes it crystal clear, doesn't it? This is what Wall Street calls a classic late-cycle rotation. It's what happens when investors start getting nervous about where the economy is headed. They sell the high-flying growth stocks like tech, and they move that money into stuff they see as safer, more tangible, things like materials and energy that do well with inflation. It's the market screaming that it's prioritizing safety over speculation.
All right, we have covered a ton of ground, the landscape, the drivers, the trends. So for our final section, let's bring it all home and build an actionable playbook. This is about taking all that info and boiling it down into a clear framework to help you navigate what's ahead. What are the key things you really need to be watching?
Let's break it down nice and simple. On the risk side of the ledger, you've got to watch out for that sticky inflation and the potential for new geopolitical shocks. There's also a risk of an AI hype correction. And yeah, analysts are still putting a 35% chance on a recession. But for every risk, there's an opportunity. The long-term productivity gains from AI are a huge tailwind. Commodity plays like energy and gold are shining. And as the world gets more complex, new opportunities in areas like nuclear and electrification are starting to pop up. So, to make it even more practical, here are 3 things to keep on your personal dashboard this year. Number 1, watch oil prices. They're your best real-time indicator of geopolitical tension and inflation. Number 2, keep an eye on the Fed and the inflation data. Their decisions on rates will move everything. And number 3, follow those geopolitical headlines. As we've seen, they're not background noise anymore, they are primary market driver.
And, of course, a quick but very important reminder, this content is for educational and informational purposes only. It is not financial or tax advice. You should always do your own research and consult with a qualified professional.
We really hope this deep dive has been valuable for you. If you want to stay ahead of the curve in this incredibly complex market, please do us a favor and subscribe, like, and share ValueVest Daily. We put this out to give you daily learning opportunities before you put your hard-earned money to work. And one last thing, we would love to hear from you. We want this to be a conversation. What high-risk, high-reward opportunities are you watching right now? Let us know in the comments below. We read every single one, and it helps us figure out what to cover next. Thanks so much for watching.